Part 1, Introduction, the rise of financial drug. Imagine you're browsing the web and see a pair of dream shoes for $200. Part of your brain, the limbic system responsible for desire, immediately says, I need it. But another part, the prefrontal cortex responsible for reason, warns, your account balance is insufficient. Wait until next month. In the past, reason usually won. You would close the browser and wait. But in 2026, this battle is over before it even begins. Right below the Buy Now button is a small, tempting blue line of text, or 4 interest-free payments, each only $50. In an instant, your psychological barrier crumbles. $200 is a large sum, but $50? That's just the price of a dinner out. You press the button, and that's the moment the trap snaps shut. Buy now, pay later. BNPL isn't simply a payment method. It's a kind of financial drug refined in Silicon Valley labs. It's designed to trick the human biological system, separating the joy of ownership from the pain of payment. Historically, debt has been associated with a heavy burden. You have to go to the bank, sign papers, face daunting interest rates. BNPL has erased those feelings. It transforms debt into a smooth experience, a lifestyle, even a privilege. But behind that smoothness lies a harsh reality. When you split your payments, you're also splitting your own financial awareness. You no longer see one $1,000 debt, you see 10 $100 debts. And when those 10 debts start draining your account on the same day, the initial convenience turns into a silent liquidity crisis. BNPL is invisible debt. It's invisible because it doesn't show up on your credit report until it's too late. It's invisible because it lurks beneath everyday trifles. And by 2026, it's silently draining the future of a generation, turning them into people working just to pay off debts for things they don't even love when the final payment is made. Part 2, the scene of the case, the explosion of uncontrolled debt in 2026. By 2026, the scene of uncontrolled debt is no longer confined to high-end fashion boutiques or expensive electronics websites. It has spread like a financial virus, infiltrating every corner of everyday life. Entering 2026, a dangerous shift has occurred. Consumers are beginning to use uncontrolled debt for daily necessities. As inflation erodes real income, apps like Affirm, Klarna, and Afterpay are quickly filling that gap. Currently, you can see the pay in 4 installments option appearing at grocery stores, splitting your grocery bill into weekly payments, gas stations, paying in installments for a full tank of gas, utility payments, splitting electricity, water, and internet bills. When a society begins borrowing to pay for things that will be consumed immediately, like food or fuel, it's a sign of an economy nearing a breakpoint. Consumers are eating into the future just to sustain the present. The reason BNPLs are called invisible debt is because of the lack of transparency in the financial reporting system. In a traditional debt system, if you borrow from a bank or have credit card debt, that information is updated to credit rating agencies like Experian or Equifax. Other creditors would know how much you owe to assess risk. However, the vast majority of BNPL loans in 2026 will still be in the gray area. Consequence: a person could have 5 installment payments on 5 different apps, and their credit score would still look very clean. This creates an illusion of financial health, causing banks to continue granting them more credit card limits, piling debt upon debt until the entire system collapses. Large retail corporations in 2026 became the most effective accomplices of BNPL. Amid declining purchasing power, they used BNPL as a stimulant to clear inventory. Instead of lowering product prices, which reduces profit margins, they maintained high prices but offered smaller, more flexible payment options. This created a phenomenon called price inflation. Consumers were willing to pay a higher price for an item simply because the monthly payments seemed more affordable. This was a silent shift of wealth from workers to retail corporations and fintech companies. Internal reports from the financial industry in 2026 revealed alarming figures. Delinquency rates. Among users under 30, the delinquency rate had skyrocketed to 20%, higher than the peak of the 2008 subprime mortgage crisis. Circular effect. 30% of subprime mortgage users reported having taken out another loan, often a high-interest credit card just to pay off their old subprime mortgages. The 2026 subprime mortgage crisis presented a chaotic picture. Consumers were trapped in an endless cycle of debt, financial companies faced enormous bad debt risks, and the economy relied on artificial consumption. The trap was perfectly laid through convenience. To understand how silicon algorithms have hacked into our brains to turn debt into joy, we need to delve deeper into the core extraction mechanism in the next section. Part 3, the core mechanism, the algorithm behind the trap. By 2026, buy now, pay later, BNPL, will no longer be simply a payment button. It will have become a complete behavioral engineering system. BNPL companies aren't just selling you the ability to pay in installments. They're selling you the illusion of temporary wealth in exchange for long-term financial slavery. In economic psychology, humans have a natural mechanism called payment pain. When you hand over a bill or see a large amount of your bank balance decrease, the brain activates the insula, the area associated with physical pain. This is a warning system that helps us stop wasteful spending. BNPL's algorithm is designed to exploit this mechanism. Psychological fragmentation. By dividing $1,000 into 4 $250 portions, BNPL reduces the intensity of activation in the insular cortex. The brain no longer sees it as a big loss, but as a small expense. Swipe to buy interface. BNPL apps use catchy sound effects, soothing pastel colors, and smooth buttons to create an instant dopamine rush. Shopping becomes a gamification, where spending money brings a feeling of exhilaration rather than regret. Many people wonder, if they don't charge interest, 0% interest, where do they get the money? The answer lies in a darker profit structure. Late fees. BNPL doesn't make money when you pay on time. They make money when you fail. By 2026, these late fees will have been refined so they aren't so high as to scare you, but enough to add up. This is a business model based on anticipating customers facing financial difficulties. Merchant discounts. Retailers are willing to pay BNPL companies 4 to 8% of the order value. Why? Because data shows BNPLs help increase the average order value by over 40%. Sellers don't care if you're in debt. They only care if you've bought more than intended. Exploiting behavioral data. BNPL apps track your every move. They know which brands you like and at what times of day you tend to be more tempted, usually late at night or on weekends, to push you split deals notifications at the right time. This is the most dangerous mechanism of BNPL in 2026. Because BNPL doesn't rigorously check repayment capacity like traditional banks, consumers easily fall into a vicious cycle: debt to pay off debt. A large percentage of users in 2026 will be using credit cards with interest rates of 25% plus to pay off their BNPL installments when they are due. Liquidity illusion. When you have 10 different installments for 10 different items, each only $20, 3-0, you feel fine. But when they all automatically deduct money on payday, you suddenly find yourself without money to eat. By 2026, BNPL will be deeply integrated into social media. AI algorithms will analyze photos you like on Instagram or videos you watch on TikTok to identify items you're craving. Just seconds later, an advertisement will appear with the message: for only $15 a week, this item is yours. This is a targeted attack on human will. BNPL doesn't wait for you to have a need. It creates the need and simultaneously provides a toxic financial solution to satisfy that need immediately. Part 3, expose that BNPL is not a humane financial service aimed at helping the poor. It is a futuristic core skimming machine powered by algorithms. It steals your sanity with dopamine and your money with psychological fragmentation. To better understand the direct victims of this machine, those sacrificing the freedom of the next 10 years for today's possessions, we will move on to Part 4, Targeted Victims, in the next segment. Part 4, the target victims, the live for today generation. By 2026, buy now, pay later, BNPL, had become a toxic coming-of-age ritual for Gen Z and millennials. For these generations, BNPL wasn't a financial choice, but a compulsion to live. As they entered the labor market with inflation-stricken wages and mounting student debt, BNPL appeared as a false savior. One of the cornerstones of traditional financial prosperity was the ability to postpone gratification, saving today to buy tomorrow. BNPL wiped this concept off the mind map of the younger generation. The I deserve it mentality. BNPL marketing campaigns preyed on this compensatory mindset. They tell struggling young people, life is already tough, you deserve these shoes, this trip right now. The disappearance of long-term goals. When monthly income is divided among dozens of invisible installment payments, the ability to save for bigger goals like a down payment or startup capital is completely eliminated. They are trapped in a loop of short-term pleasures worth $25. Social media is the biggest accomplice in this case. By 2026, the line between reality and illusion will have blurred. Glamour on debt. The glamorous travel photos or designer clothes on Instagram are often financed by split payments. BNPL allows young people to maintain a facade of success that they can't actually afford. The price of comparison. Seeing friends own the latest things triggers the fear of being left behind, FOMO, activating the shopping instinct. BNPL offers an easy escape from that fear, but it leaves a silent debt anxiety behind the phone screen. BNPL apps have launched a linguistic attack on the psychology of young people. Instead of saying a product costs $300, they advertise it as 4 payments of $75 or $15 per week. Cognitive paralysis. To a young brain under pressure, $15 seems insignificant. It's just the price of 2 cups of coffee. But when you have 10 such $15 payments, you're losing $150 per week or $600 per month. Financial black hole. Gen Z often doesn't total up these installments until they see their bank account empty in the middle of the month. They're living in an illusion of cash flow, while in reality they're bankrupt on every small purchase. The most profound consequence of debt-based lending is that it has left a generation without the ability to manage their budgets. Forgetting how to save. When everything can be bought instantly with debt, financial planning skills atrophy. Loss of risk assessment ability. Because debt-based lending doesn't have a clear interest rate if repaid on time, users lose sensitivity to the cost of debt. This makes them more likely to accept more toxic loans in the future, such as high-interest loans or credit cards, when debt-based lending starts to get out of control. Part 4 reveals a painful truth. Debt-based lending is eroding the future of Gen Z and millennials. They don't just owe money, they owe freedom and long-term growth opportunities in exchange for short-term consumption. They are building their lives on a foundation of sporadic payments that can collapse at any time when the economy fluctuates. To understand what will happen when this consumer bubble reaches its limit, we will move on to Part 5, the system breakpoint, where the illusory numbers meet the harsh reality of 2026. Part 5, the systemic breakpoint when the consumer bubble burns. By 2026, buy now, pay later BNPL will no longer be a story of personal convenience. It will have accumulated enough weight to become a systemic risk. As central bank interest rates remain high to combat inflation, the cheap money model fueling BNPL will begin to reveal deadly flaws. If 2008 was the subprime mortgage crisis, 2026 will be the consumer subprime mortgage crisis. Zero collateral. Unlike mortgages, where the property itself is used as collateral, BNPL debt is used to buy clothes, food, and electronics, items that depreciate as soon as they leave the store. When consumers default en masse, BNPL companies have no assets to recover. Domino effect. BNPL companies often borrow money from large banks to finance your installment payments. When the BNPL's delinquency rate exceeds 1, 5, 20%, the company's own loans begin to be called out, creating a ripple effect that shakes the traditional banking system. The business model of BNPL companies in 2026 faces a harsh reality. Rising capital costs, but they cannot increase fees to users without losing customers. Negative profit margins. With rising bank loan interest rates, but offering 0% interest to users, these companies are burning money to maintain market share. Market purge. We witnessed the collapse or mass acquisition of smaller BNPL applications. When an app goes bankrupt, users' debts are often sold to aggressive debt collection companies, turning the $25 installment dream into a legal nightmare and extreme psychological pressure. This is the deepest wound that BNPL, borrowed non-performing loans, will leave for the younger generation in 2026. Although initially considered invisible debt, credit rating agencies have eventually begun integrating BNPL data into their FICO scores. A trace of risk. A long history of small installment payments, even when paid on time, is seen by mortgage application algorithms as a sign of an individual living paycheck to paycheck. The door to home ownership slams shut. Millions of young people in 2026 realize that because of shoes and meals paid for in installments a few years ago, they are denied first-time home loans or face extremely high penalty interest rates. BNPLs steal long-term asset ownership in exchange for short-term consumption. By 2026, financial regulators will begin cracking down on BNPLs with regulations equivalent to those on credit cards. Transparency requirements. BNPL companies will be required to publicly disclose the actual interest rate, APR, including hidden fees. Affordability checks. 30-second approvals will be banned, replaced by stricter income verification processes. However, this intervention occurred when the bubble had already grown too large, causing a heat shock in the consumer market and a sudden drop in global purchasing power, contributing to the economic recession. Part 5 shows that nothing is truly free in finance. The convenience of BNPLs is a loan from the future, with interest being your own freedom and opportunity. The 2026 systemic turning point serves as a warning that consumption not based on real labor productivity is merely a temporary illusion. In the final section, we will explore how to break free from these digital shackles to rebuild a solid and independent financial mindset. Part 6. Conclusion. Breaking free from digital shackles. The 2026 BNPL crisis is a costly wake-up call for a generation that mistakenly believed convenience was a free privilege. To reclaim financial sovereignty, we need a reverse revolution, a return to the core principles that helped the middle class prosper in the past. The best way to break the BNPL algorithm is to restore the connection between the brain and the wallet. Cash or debit card mindset. Stop splitting payments. If you can't afford the whole thing right now, it means you can't afford it. Paying upfront forces the brain to feel the pain of paying, thereby activating the rational filter to eliminate needs that align with fleeting desires. Eliminate temptation apps. The first step in the detox process is to remove BNPL apps from your phone and disconnect them from e-commerce sites. Make shopping a little more difficult. This very resistance is your best defense. To combat AI algorithms that track behavior, you need to build a firewall in your mind. The 7-2-hour rule. For any high-value item, not a necessity, force yourself to wait 72 hours before paying. During those 3 days, dopamine levels will drop, the allure of the item will fade, and you'll realize you don't really need it that much. Redefine wealth. Wealth isn't about showing off to the world through installment payments. It's about what you actually own and assets that generate income while you sleep. A pair of shoes on installment is a liability. A stock or a new skill is an asset. Let's do a simple calculation. Instead of paying $100 a month for old non-performing loans, NPLs, if you invest that $100 in an index fund with a 7 to 10% annual interest rate, after 10 years, you'll have an incredible amount. Inverse compound interest. NPLs are inverse compound interest. You're enriching fintech companies with your own future. Freedom is debt-free. The feeling of waking up without a payment due notification in your email is worth more than any luxury item. Financial freedom begins the moment you refuse to borrow from the future to fuel present vanities. The 2026 NPL case shows us that the more advanced technology becomes, the more sophisticated the traps for human psychology become. Algorithms don't care about your life when you're 50. They only care about extracting value from you right now. Breaking free from the shackles of BNPL isn't just about managing money. It's a battle for self-mastery. Don't let your life be broken down into $25 payments. Be the true owner of your time, effort, and future. Sustainable wealth is never built on promises of pay later. It's built on discipline, patience, and mindful decisions made today.